Hey, welcome back. Let me ask you something that every crypto investor thinks about, but most are afraid to say out loud. Is there actually a way to know when the next bull run is coming before it starts? And the honest answer is this: you cannot predict it with perfect precision. Nobody can. Anyone who tells you they can pinpoint the exact date the next bull run begins is either lying to you or lying to themselves. But here is what you absolutely can do. You can identify the conditions that have historically preceded every single major Bitcoin bull run. You can monitor the specific signals that appear in the months before a significant market expansion. And you can position yourself accordingly before the mainstream crowd arrives and prices the opportunity away. This is not about predicting the future. It is about reading the present clearly enough to understand what the data is telling you about what comes next. The investors who consistently do well in crypto are not the ones with the best crystal balls. They are the ones with the best frameworks for reading early signals. They are positioned before the excitement peaks, and when the crowd finally arrives, they already have the positions that the crowd is now paying a premium to buy. Today, I am going to give you that framework. Let us get into it. Understand what actually drives bull runs. Before you can identify when a bull run is coming, you need to understand what actually causes them. Because if you understand the causes, you can watch for the conditions that create them. There are four primary drivers of crypto bull runs, and they almost always appear together in the period leading up to a major market expansion. Driver 1: the Bitcoin halving. Every 4 years, approximately, the amount of new Bitcoin created with each block is cut in half. This programmatic supply reduction has preceded every major Bitcoin bull run in history. The halving does not instantly cause a bull run, but it changes the fundamental supply and demand equation in Bitcoin's favor. In the months and sometimes up to a year after each halving, the reduced new supply combined with steady or growing demand has consistently created significant upward price pressure. Driver 2: macroeconomic conditions. Crypto does not exist in a vacuum. It is deeply influenced by the broader global financial environment. When interest rates are high, capital tends to stay in safer assets like bonds and cash. When interest rates fall and monetary conditions loosen, investors seek higher returns and riskier assets, including crypto benefit. Watching central bank policy cycles is one of the most valuable macro indicators for crypto timing. Driver 3: institutional adoption milestones. Each cycle has been amplified by a significant new wave of institutional participation. The approval of Bitcoin ETFs, major corporations adding Bitcoin to their balance sheets, sovereign wealth funds gaining crypto exposure. These institutional milestones bring enormous new capital into the market. Watching for the next wave of institutional entry is a powerful leading indicator. Driver 4: technological development and narrative catalysts. Each bull run has been associated with a compelling new narrative that attracted attention and capital. Decentralized finance, non fungible tokens, layer 2 scaling. Each narrative created excitement around genuine technological development that pulled new participants into the ecosystem. When multiple of these four drivers are aligning simultaneously, the conditions for a bull run are forming. The halving cycle as a timing framework. The Bitcoin halving is the most reliable structural timing tool available for anticipating broad market cycles. Here is the historical pattern. After each halving, there has typically been a period of 6 to 18 months before the market enters its most explosive growth phase. The halving changes the supply equation, but the market takes time to fully price in that change. Miners receive less Bitcoin as reward, and the reduced selling pressure from miners combined with steady demand gradually shifts the market balance. The first halving occurred in 2012. The major bull run followed in 2013. The second halving occurred in 2016. The extraordinary bull run peaked in late 2017. The third halving occurred in May 2020. The bull run peaked in late 2021. The pattern is not perfectly consistent in timing. The lag between the halving and the peak varies. But in every case, significant bull market expansion has followed each halving. Here is how to use this practically. Mark the date of the most recent halving on your calendar. Begin your research and gradual position building in the 6 to 12 month window following the halving. This is historically the sweet spot for accumulation before the mainstream expansion phase begins. The further you are from the halving, the later you likely are in the potential expansion window. The closer you are to the next halving, the earlier you are in the setup phase for the following cycle. The halving gives you a structural calendar for the macro cycle. It is not a perfect entry signal by itself, but combined with the other indicators we are about to cover, it provides essential context for every other decision you make. On-chain signals that precede bull runs. On-chain data comes directly from the blockchain itself and cannot be manipulated or faked. It tells you what investors are actually doing with their Bitcoin rather than what they are saying they are doing. Here are the four most important on-chain signals to watch before a bull run. Signal 1. Long-term holder supply increasing. On-chain analytics platforms like Glassnode categorize Bitcoin wallet addresses by how long they have been holding their coins. When the percentage of Bitcoin supply held by long-term holders, typically those holding for more than 1 year, is growing steadily, it means experienced investors are accumulating and not selling. Rising long-term holder supply in a period of low or declining prices is one of the strongest early signals of an impending cycle change. Signal 2. Exchange outflows increasing. When Bitcoin moves off exchanges and into private wallets, it typically signals that holders intend to hold rather than sell. Sustained high exchange outflows mean less Bitcoin is available for immediate selling. Reduced available supply in a market where demand eventually returns creates significant upward price pressure. Signal 3. Bitcoin dormancy and coin days destroyed declining. Coin days destroyed is a metric that weights Bitcoin movement by how long the coins have been sitting still. When this metric is low, old coins are not moving. Long-term holders are not selling. When this metric spikes, old coins are moving, often signaling that long-term holders are distributing. Low and declining coin days destroyed during a price recovery phase signals that the smart money is holding and waiting for higher prices. Signal 4. The MVRV ratio reaching historically low levels. MVRV stands for market value to realized value. It compares Bitcoin's current market price to the average price at which all Bitcoin was last moved. When this ratio drops to historically low levels, it indicates that the average Bitcoin holder is sitting at a loss or at break-even. Historically, extreme lows in this ratio have closely coincided with cycle bottoms and preceded significant recoveries. Monitoring these on-chain signals collectively paints a clear picture of where the market is in its cycle and whether the conditions for the next expansion are forming. Macro and institutional indicators. Beyond the Bitcoin-specific signals, the broader macro and institutional environment provides crucial context for timing crypto market cycles. Macro Indicator 1. Central bank interest rate cycles. When central banks begin cutting interest rates, liquidity conditions loosen. Capital that was sitting in cash and bonds seeking yield begins looking for higher return opportunities. Historically, the period following the beginning of rate cutting cycles has been favorable for risk assets, including crypto. Monitoring central bank policy signals and interest rate expectations is a valuable macro timing input. Macro indicator 2. Dollar strength and weakness. Bitcoin and the US dollar have historically shown an inverse relationship. When the dollar weakens, Bitcoin tends to strengthen as investors seek alternative stores of value. Watching the dollar currency index, commonly called the DXY, as a background indicator provides additional macro context for crypto timing. Institutional indicator 1. Regulatory clarity milestones. Major institutional capital flows into crypto require regulatory clarity before compliance departments will approve meaningful allocations. Watching for significant regulatory milestones, whether ETF approvals, clear legal frameworks, or major sovereign adoption, signals that the gates for institutional capital are opening wider. Institutional indicator 2. Corporate and sovereign treasury adoption. When publicly traded companies or sovereign wealth funds announce significant Bitcoin treasury allocations, it validates the asset class to an enormous audience of investors who had been watching from the sidelines. Each major adoption announcement typically brings new capital from entities that were waiting for that validation signal. The convergence of loose monetary policy, dollar weakness, regulatory progress, and institutional adoption news creates the macro backdrop that supports and amplifies the structural cycle signals we covered in the previous sections. Sentiment indicators and crowd psychology signals. The final category of bull run prediction signals comes from sentiment and crowd psychology. Markets are ultimately driven by human behavior, and human behavior creates measurable patterns. Sentiment signal 1. The fear and greed index at extreme fear levels. The crypto fear and greed index measures market sentiment on a scale of 0 to 100. 0 represents extreme fear, 100 represents extreme greed. Historically, readings in the extreme fear zone, below 20, have closely coincided with market bottoms and preceded significant recoveries. When the entire market is scared and the index is deeply in the fear zone, it signals that selling pressure may be exhausting itself. Sentiment signal 2. Google Trends and social media search volume at multi-year lows. When public interest in Bitcoin as measured by search volume and social media discussion is at its lowest point in years, it confirms that the retail crowd has largely left the space. Low search interest means low buying pressure from retail, but it also means the next wave of incoming retail attention has not yet arrived, which historically coincides with early cycle positioning opportunities. Sentiment signal 3. Media narrative turning from negative to neutral. Crypto bear markets generate negative media coverage. Stories about project failures, regulatory crackdowns, and declarations that Bitcoin is dead are common. Watch for the media narrative to shift from actively negative to neutrally interested. This transition often occurs in the early stages of a new accumulation phase before the positive coverage that accompanies a full bull market begins. When extreme fear, low search interest, and transitioning media narrative all appear together, alongside the structural and on chain signals we covered earlier, the convergence of evidence becomes very compelling. Let me bring your complete bull run prediction framework together. Understand the four drivers: the Bitcoin halving, macro conditions, institutional adoption milestones, and technological narrative catalysts. When multiple drivers are aligning, bull run conditions are forming. Use the halving as your structural calendar. The 6 to 12-month window following a halving has historically been the accumulation sweet spot before mainstream expansion begins. Monitor on-chain signals: rising long-term holder supply, increasing exchange outflows, low coin days destroyed, and MVRV at historically low levels all signal that the cycle is bottoming and smart money is accumulating. Watch macro and institutional indicators. Rate cutting cycles, dollar weakness, regulatory milestones, and corporate or sovereign treasury announcements create the macro environment that supports and amplifies crypto bull runs. Track sentiment signals. extreme fear index readings, multi-year low search volume, and a media narrative transitioning from negative to neutral confirm that retail capitulation has occurred and the next wave of attention has not yet arrived. Here is the most important thing I want to leave you with. No single signal tells the whole story. What you're looking for is convergence. When multiple signals from multiple categories all point in the same direction at the same time, the probability of a significant market expansion increases dramatically. And here is the practical application that matters most. By the time all of these signals are confirmed and the evidence is overwhelming, prices will have already moved significantly. The investors who benefit most are not the ones who wait for certainty. They are the ones who act on the early convergence of signals and build positions gradually as the evidence accumulates. Certainty in markets always comes at a premium. Early positioning based on systematic signal monitoring is how you avoid paying that premium. Start monitoring these signals now, not when the next bull run is already underway. Now, while the market is wherever it is today. Build the habit of tracking these indicators consistently so that when the signals begin converging, you recognize it immediately and act with confidence. If this framework gave you a systematic approach to anticipating crypto market cycles, please hit the like button and subscribe. This is the kind of analytical framework that most retail investors never develop, and it creates a genuine edge over time. Drop a comment below and tell me this. Which of these signal categories are you going to start monitoring first? I read every comment and I will give you specific resources for tracking the indicators you choose. I will see you in the next one.